Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of cryptocurrency regulation, balancing innovation, security, and global challenges. Cryptocurrencies have reshaped how we think about money and financial systems. Since Bitcoin's debut in 2009, the idea of decentralized digital currencies has evolved into a trillion-dollar industry. But with their rapid growth comes a big question: how do we regulate them without stifling innovation? Striking the right balance between protecting consumers, preventing fraud, and fostering technological progress isn't easy. In this video, we'll explore why regulation has become such a hot topic and what it means for the future of cryptocurrencies. What is cryptocurrency regulation? As cryptocurrencies gain traction across the globe, the question of how to regulate them becomes more pressing. In simple terms, cryptocurrency regulation refers to the rules and laws that govern how digital assets are issued, traded, and used. These rules can vary by country but are fundamentally designed to address risks while allowing innovation to thrive. Think of it as creating traffic laws for a new kind of vehicle, ensuring safety without halting progress. Key objectives of cryptocurrency regulation. Cryptocurrency regulation focuses on tackling several important goals to ensure a fair, secure, and transparent environment. Here are the key objectives. Transparency. Cryptocurrencies often operate in decentralized and pseudonymous networks. Regulations aim to improve transparency by requiring companies and platforms to adhere to standards like Know Your Customer, KYC, and anti-money laundering, AML. These measures help identify who's involved in transactions, making it easier to spot suspicious activities. Security. As crypto markets grow, so do the risks of hacking, fraud, and scams. Regulations are designed to set minimum security standards for crypto exchanges, wallets, and platforms, helping to safeguard user funds and prevent breaches. Prevention of illicit activities. Digital currencies can be misused for criminal purposes, such as money laundering, tax evasion, or funding illegal organizations. Governments see regulations as a way to close these loopholes by monitoring transactions more effectively and enforcing compliance checks. Consumer and market protection. The promise of high returns has lured many people into crypto investments without understanding the risks. Regulations aim to protect consumers from misinformation, unreliable projects, and fraud-filled initial coin offerings, ICOs, while also ensuring fair markets that prevent manipulation and insider trading. By addressing these areas, cryptocurrency regulation tries to strike a balance between fostering trust and curbing misuse. Who regulates cryptocurrencies? When it comes to regulating cryptocurrencies, multiple entities play crucial roles. No single global authority oversees crypto. Instead, different regions employ different strategies. Here's a breakdown of the main players. Governments. National governments create policies and laws tailored to their unique economic and social needs. For instance, the United States regulates crypto as both a security and a commodity, depending on the situation. Meanwhile, countries like El Salvador have embraced Bitcoin as legal tender, which has led to entirely different approaches to regulation. Financial authorities. Regulatory bodies like the U.S. Securities and Exchange Commission, SEC, the Commodity Futures Trading Commission, CFTC, and the European Securities and Markets Authority, ESMA, keep an eye on crypto to ensure compliance with financial laws. These entities focus on preventing fraud, protecting investors, and maintaining market integrity. International organizations. Groups like the Financial Action Task Force, FATF, set global standards by guiding countries on how to regulate cryptocurrencies, particularly around AML and KYC practices. Though they don't create laws, their recommendations carry significant weight. Central banks. Many central banks are involved in cryptocurrency regulation due to concerns over monetary policy, currency stability, and the rise of stablecoins. Some have even begun developing their own central bank digital currencies, CBDCs, in response to the growing crypto ecosystem. Each of these entities approaches regulation with different priorities, but they often overlap in aiming to create an environment that benefits both investors and the broader economy. Understanding who's behind these guidelines helps us see how regulation shapes the future of cryptocurrency use. The current state of global cryptocurrency regulation. As cryptocurrencies continue expanding into mainstream finance, governments worldwide are struggling to establish effective guidelines. Some countries have embraced digital assets as an economic opportunity, while others view them as a threat to financial systems. What's clear is that no one-size-fits-all approach exists. Each region's strategies reflect priorities unique to their markets and geopolitical concerns. Let's take a closer look at how key regions are addressing crypto regulation. United States, a fragmented approach. Cryptocurrency regulation in the U.S. is complex, largely because no single entity oversees it. Instead, multiple agencies have overlapping responsibilities, each interpreting crypto differently. SEC, Securities and Exchange Commission. The SEC views many cryptocurrencies as securities, similar to stocks. Their focus is on protecting investors, ensuring transparency, and cracking down on misleading initial coin offerings, ICOs, or celebrity-endorsed schemes. The question of whether certain tokens, such as Ethereum, qualify as securities continues to cause friction between regulators and crypto companies. CFTC, Commodity Futures Trading Commission. The CFTC classifies cryptocurrencies like Bitcoin as commodities. They regulate futures and derivatives markets tied to crypto assets, ensuring fair trading and preventing manipulation. This creates a gray area since some digital assets fall into both the SEC's and CFTC's jurisdictions. IRS, Internal Revenue Service, for taxation. The IRS categorizes cryptocurrencies as property. This means crypto trades and even simple purchases made with Bitcoin are taxable events. The unclear tax reporting requirements for crypto users have drawn criticism, prompting calls for simplified rules. The U.S. lacks cohesive federal crypto legislation, and much authority rests with states. For example, New York's BitLicense is notorious for its strict compliance requirements. On the other hand, Wyoming has emerged as a crypto-friendly hub, attracting blockchain startups with favorable regulations. This patchwork approach leaves businesses navigating regulatory uncertainty. European Union. Clearer frameworks in the making. The European Union has taken strides toward unified cryptocurrency regulation with its upcoming Markets in Crypto Assets (MiCA) framework. Set to take effect in 2024, MiCA aims to standardize rules for crypto businesses across all EU member states. Here's what MiCA covers: consumer protection. Crypto platforms must provide clear disclosures about their services, risks, and fees. This reduces the likelihood of consumers falling into scams or misinformation. Stablecoin regulation. Issuers of stablecoins, crypto pegged to traditional currencies like the euro, must maintain sufficient reserves to back their value. Licensing requirements. Exchanges, wallet providers, and other crypto service providers will need EU licenses to operate legally. MiCA's introduction represents a monumental step toward reducing regulatory uncertainty while fostering growth in Europe's blockchain sector. It creates predictability for crypto businesses looking to expand across the EU, signaling a shift toward a pro-innovation stance while safeguarding users. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.